Central bank policy decisions will hug the market headlines in the coming week, at least unless geopolitics in the Middle East take a hand, although none of those three central banks are actually expected to do much, if anything, this time around. First up will be the Bank of Japan on Tuesday the 31st of October. The BOJ remains the outlier among developed monetary authorities in that it has not raised interest rates, even if inflation is currently running above its 2% target. Governor Katsuo Ueda and colleagues are expected to leave the headline main policy rate unchanged at minus 0.1%, a level first adopted in February 2016, though they could fiddle with the cap that they're prepared to exceed on the 10-year Japanese government bond, so watch out for that. Next will be the US Federal Reserve on Wednesday the 1st of November. Since March 2022, the Fed has jacked up the Fed funds rate to 5.5% from just 0.25% and run quantitative tightening at $47.5 billion and then $95 billion a month. That run rate has helped the Fed to trim its bloated balance sheet by $1 trillion or 12% from the spring 2022 peak. For this meeting, the Federal Open Markets Committee, while markets are putting a 94% probability on no change in the Fed funds rate at 5.5%, with an expectation there'll be a maximum of one more rate hike before they pause for good. The Fed's first rate cut, well, that's currently priced in for July 2024. And last, but by no means least, our very own Bank of England on Thursday the 2nd of November. Since December 21, Governor Andrew Bailey and the Monetary Policy Committee have increased the base rate from 0.1% to 5.25% and trimmed its bond holdings by 15% to £758 billion from a peak of £895 billion. Now, the plan is to cut the balance sheet by a further £100 billion to £658 billion in the next 12 months, and therefore no change is expected in quantitative tightening at this meeting, and Mr. Bailey and colleagues are expected to hold rates at 5.25% as well. Rather like the Fed, the Bank of England's talking tougher for longer or higher for longer, but markets currently expect one more rate hike at the most before a first cut in late 2024. As if that triple-decker wasn't enough, we've a strong slate of scheduled corporate reports, with more than a sixth of the FTSE 100 due to update shelves in some way, shape or form in the coming week. Beware of last-minute date changes, but names which could be worthy of further research include the following: HSBC, Glencore, Pearson, Airtel Africa and Computer Centre on Monday the 30th of October. BP, Coca-Cola, HSBC and Elementis on the 31st. Next, GSK, Weir, Smurfit Kappa and Aston Martin Lagonda on Wednesday the 1st of November. And BT, Sainsbury, Haleon, Smith & Nephew, Hikma Pharmaceutical, Howden Joinery, Entain, Trainline, Derwent London OSB on Thursday the 2nd, ahead of what looks like at the moment a quiet day on Friday the 3rd. However, the company which may just cause the biggest fuss in the week ahead is Shell. The oil and gas major is due to release its third quarter results at the end of September on Thursday the 2nd of November. Now that's 2 days after BP, but we've decided to look at Shell this time because it is once more the biggest stock in the FTSE 100 by market capitalisation and because its shares are at a new all-time high, at least at the time of recording. Now, Shell's preferred profit metric is not a statutory one, but it's adjusted on an underlying basis earnings using current cost of supplies, or CCS, which excludes the effect of commodity price changes on the value of stockpiles on its balance sheet. Adjusted earnings were $9.6 billion in Q1 and $5.1 billion in Q2. The benchmark comparison for the third quarter a year ago is $9.5 billion. Analysts will also look to the mix of earnings between upstream, integrated gas, marketing, which is refining in petrol stations, and chemicals and renewables. Note from the chart how upstream and integrated gas profits have swung around as oil and gas prices have ebbed and flowed, while refining and trading activities have seen big swings at chemicals too. There are a lot of moving parts here. Attention will then switch to cash flow from operations, which hit the double-digit billions figure for the sixth time in 7 quarters in Q2. And cash flow is important because it funds investment in the business, and after that, cash returns to investors as well as debt reduction. Shell returned $8 billion to shareholders in the first half alone via buybacks, with $4 billion in dividends on top. Shell also launched a new $3 billion buyback in the third quarter alone, and markets will be looking to see if the dividend goes up again after the second quarter's increase to 33.1 US cents a share. The last number that may grab the headlines is capital investment. At the first half stage, Chief Executive Vail Sawan lowered the guidance range for 2023's capex budget, $23 to $26 billion, and established a lower range still for 2024 and 2025 of between 22 and 25 billion. Such a budget leaves the capex to sales ratio in the middle of the historic range no more. Even if oil and gas prices are firm, demand seems strong and supply of hydrocarbons isn't growing that much, if at all. Moreover, the spending mix will be important as Shell seeks to reposition itself for a net zero carbon world going forwards. At the moment, it seems keen to monetize the value of its existing hydrocarbon assets. I hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you again next time.